The central banks of the world have purchased 1,250 metric tons of gold, which is worth about $80 billion. And when we talk about a government that by its own estimate will take another 22 trillion in debt over the coming decade just to keep the lights on, so to speak, to roll over the obligations that we have, and to continue to fund our spending habits, well, that's an awful lot of money, and I'm sure that those are severe concerns. But think about this. In other words, if the central banks were to purchase, let's say, 5% hold right now in U.S. dollars, just converting 5% would be another 300 to 400 billion in purchases. Now, an $80 billion infusion pushed gold up to its all-time high. At the same time, we have a strong dollar, we have positive real yields, and outflows out of the ETFs. What happens if they just convert 5% of their dollar holdings? And it seems that this has been a trend that's been accelerating. Now, granted, that's $300 to $400 billion. That's 5 times what they bought over the last couple of years. But what I'm getting at is that as these central banks continue to de-dollarize, they realize that inflation has been chosen over austerity, the way that all governments have. What I'm trying to say to you is this: you add that kind of money, you're talking gold that could easily be up above $10,000, because 80 billion pushed it up here to 2,600 and change with virtually no U.S. participation. And I think that you are seeing and will see kind of like a hockey stick, right? Where the acceleration in de-dollarization accentuates. And I really do believe that that's as crazy as it sounds to me, a conservative estimate. I can't imagine that all you would see is 5% of the 8 trillion in US dollar holdings that these central banks hold around the globe would be converted to gold. I think that number will be much more. But 5% would be 300 to 400 billion injection into gold. And that's 5 to 6 times what they've already bought in the last 2.5 years, which has been the driving force behind the rise in gold. I don't know. I happen to it's rocket fuel waiting to happen. I really, truly do. And this is a trend that has done nothing but accelerate. Every time we see a Fed cut, gold has rallied as much as 10% in the 6 months after the first Fed cut. So we just saw the first Fed cut. We're seeing increased central bank demand. And we're now beginning to see the ETFs start to tick up. I mean, in terms of you try to lay out an argument for a bullish case for gold, I don't know their path, and that is one of inflation. And so when you talk about inflation, sanctioning, all of the things that these central banks are thinking of, not to mention the BRICS and their gold-backed settlement currency, which again has been reconfirmed that this indeed is real and will be discussed in the meeting here in the next 3 weeks. We could see much higher prices over the next 6 to 12 months, especially as we are now banking another 50 basis point rate cut. At least that's what the smart money thinks will happen. So yeah, in every metric, gold is at all-time highs, but maybe the flawed logic is that it should be a whole hell of a lot higher, that it's been suppressed for so long that these numbers that we are all awestruck over are really well short of the mark, just because it hasn't been able to reach its real price due to the massive shorting on both the LBMA and on COMEX. Maybe, just maybe, all of these other assets that have reached such stratospheric highs in gold and silver, kind of painting a picture, allowing most people, including maybe even you and I, to sell short where gold and silver really ought to be and where it is ultimately going.
We have some staggering numbers to look at. And if you're someone who's wondering what the future holds for gold and silver, or even for the US dollar, this is going to be a must-watch discussion. Let's start with some basic facts. Central banks around the world have purchased 1,150 metric tons of gold, which amounts to roughly $80 billion. To put that into perspective, that's a colossal amount of money flowing into a single asset class. But why is it happening? Why are central banks suddenly so keen on hoarding gold? The answer lies in the reality of our financial system. The US government, by its own estimates, will take on another $22 trillion in debt over the next decade just to keep its operations running. This includes rolling over existing obligations and funding its ever-growing spending habits. We're talking about an unfathomable amount of debt, and it's clear that traditional tools of fiscal management, taxation, and austerity are no longer viable options. What central banks are doing, essentially, is diversifying away from the US dollar. If you look at global reserves, central banks hold around $8 trillion in US dollar assets. Now imagine what would happen if they decided to convert just 5% of those holdings into gold. That would amount to an additional $300 to $400 billion flowing into gold. Let's put this into context. The recent $80 billion in gold purchases has already pushed gold to its all-time high of around $2,660 per ounce, all while the dollar remains strong, yields are positive, and money is flowing out of gold ETFs. Now imagine what would happen if central banks added another $300 to $400 billion into the mix. That's 5 times the amount they purchased over the last few years. The implications are clear. Gold could easily soar past $10,000 per ounce if this trend continues. And let me tell you, this isn't some wild prediction. This is a conservative estimate. Historically, gold has always been a hedge against currency devaluation and inflation. Central banks, being some of the most well-informed players in the financial world, are making their move before the rest of the market catches on. They see the writing on the wall, and they know what's coming. The term hockey stick comes up here, a sudden and sharp upward curve in demand. As central banks accelerate their gold purchases, we could see a similar trajectory. Every time the Federal Reserve has cut rates, gold has rallied as much as 10% in the following 6 months. We just had the first Fed cut, and with increasing central bank demand, the trajectory looks very bullish for gold. And let's not forget, we're now seeing some upticks in ETF inflows as well. For the past 2 years, we've seen consistent outflows from gold ETFs, even while the price of gold has risen by 47%. Now that the public is starting to come back into the market, combined with the actions of central banks, we could be looking at an explosive move to the upside. Let's also touch on inflation. We know that the US government and the Fed have chosen inflation over austerity, as have most governments around the world. The problem with this is that it undermines the value of their currencies, especially the US dollar. When currencies lose value, gold gains, because it's the ultimate hedge, an asset that doesn't depend on the solvency of any government or financial system. And then we have the BRICS nations. The idea of a gold-backed settlement currency has been floating around for a while, but it's becoming more and more real. There's a meeting in the coming weeks where this is expected to be discussed further. Imagine if the BRICS nations, which include some of the largest economies in the world, decided to use a gold-backed currency for trade. This would not only elevate the importance of gold as a reserve asset, but also significantly weaken the dominance of the US dollar in international trade. It's not just about moving away from the dollar, it's about moving towards something that cannot be manipulated or printed at will. Gold fits the bill perfectly. The BRICS nations understand this, and they're positioning themselves accordingly. The case for gold is extremely compelling right now. Every metric, whether it's central bank buying, ETF inflows, or Fed policy, points to much higher prices. And while mainstream analysts might be putting out modest targets of $2,900 or $3,000 per ounce, I believe, as does Andy, that these numbers are conservative. The true potential for gold, given the economic backdrop and the actions of central banks, is much higher.
The UBS says gold has risen by 29% this year, consistently breaking records on the way up. Meanwhile, the metal has risen above our long-held year-end target of $2,600, ahead of schedule. And according to the World Gold Council, as I mentioned to you, it has historically rallied as much as 10% in the first 6 months after a Fed cut. We now expect gold to reach $2,750 per ounce by the end of 2024 and to $2,900 per ounce by the third quarter of 25. Pretty significant, but not as significant as Goldman Sachs, who is talking about right now in the fourth quarter of 2025, by the end of the third quarter in 2025, $3,000 gold. By the end of the year in 2025, $3,080 an ounce. And this is elevated from $2,700 to $2,900 an ounce. Again, these banks are coming out and saying, yeah, we're moving to $3,000 an ounce. And Goldman Sachs has said that they're being inundated with precious metals requests on their trading desks, which is a very, very, very big deal, obviously. And it is being evidenced by the first time in 2.5 years, we see an uptick in ETF holdings. And so as ETF holdings pick up, as the Fed pivots and lowers rates, probably another 50 basis points here in November, this is just rocket fuel for gold, which has done what it's done. Again, rallying 29% and 47% since 2022 when we saw this divergence in 2022 where the ETF started to outflow in the US and gold started to go up, really. And so this 47% gain since 2022, as the public has not been involved in it, with positive real yield and a strong dollar. Now you see dollar kind of hanging right at that 100 mark on the Dixie, and could very well fall from there and drop a little bit or maybe a lot, of course. And then you see that the yields coming down, and now the ETFs ticking up. This is all huge. And to see Goldman and UBS say these things is again very, very significant. They're acquiescing to the reality that, again, you can only manipulate a market over an extended period of time, done again by pushing it in the direction that it is going. And that is the key, that maybe these banks realize it's as dumb as a mud wall, like Bank of America, to be naked short in a market where the rest of the world is voraciously accumulating metal, to the point where just in the month of August, 8.1% of all the silver held that's available for delivery, and the LBMA was delivered 8.1%, over 25 million ounces in the month of August. So it's accelerating the acquisition of gold. And it's also being done in a manner to not upset the apple cart, as we talked about last week, with 160 metric tons purchased by Saudi Arabia, but not disclosing it the way they're supposed to the IMF, because they don't want to upset the big kahuna, the United States. And yet they're playing both sides of this game. Ultimately, if you just put all of these things together and realize that the commercial banks and the central banks, who are the most collectively well-informed and well-financed traders in the world, are telling you where this is going. And if you don't pay attention to the Goldman Sachs report or the UBS report, where the hell do you find it, right? Where are you going to find it on the mainstream? Are you listening to the mainstream, who isn't saying a word about any of this? It's not easy to find and read through these analyst reports for UBS and Goldman Sachs. It sucks reading it, to be honest with you. And they're 25 pages of a bunch of mumbo jumbo. And then they say, yeah, gold's going to 3,000 by the end of the year. But if you only relied upon, and that you consider yourself very well read by reading the Wall Street Journal, watching Fox News, and paying close attention to the markets, you are missing this completely and totally. There is your massive contrarian indicator. Not only are the biggest boys in the world telling you, yeah, this is where it's going, but you can't find it unless you dig. I don't know. To me, it's a massive contrarian indicator, and I would say that's probably selling it short from where it ultimately goes.
Let's talk about what's likely to happen next. We already mentioned the $80 billion in recent central bank purchases, which have pushed gold to record highs despite unfavorable conditions, a strong dollar, positive real yields, and ETF outflows. Now, if central banks convert just 5% of their dollar reserves to gold, we're talking about $300 to $400 billion more being poured into the gold market. This is literally the definition of rocket fuel for gold prices. Andy Schectman mentioned how each time the Fed has cut rates in the past, gold has rallied. If the Fed is set to cut rates by another 50 basis points in the near future, we could very well see gold shoot up by another 10% or more in the next 6 months. Now consider the added central bank demand. That's a recipe for gold prices reaching levels that mainstream analysts have yet to consider seriously. The important takeaway here is that central banks are the most well-informed and well-capitalized traders in the world. When they make a move, they're not just guessing. They're basing their actions on deep analysis and foresight. Their actions signal a major shift away from the US dollar and a move towards hard assets, specifically gold. And let's be honest, if you wait for mainstream media to tell you this, you're already too late. Another crucial element to this story is the ETF inflows. For the first time in 2.5 years, we're starting to see a rise in gold ETF holdings. ETFs are a key indicator of retail and institutional sentiment, because they represent a convenient way for investors to gain exposure to gold without holding the physical metal. The rise in ETF inflows means that the broader public is finally starting to wake up. The smart money, central banks, has been buying gold aggressively, and now the public is beginning to follow. When these two forces, central bank buying and public demand via ETFs, work in tandem, you get the kind of explosive price movements that can lead to significant gains. Goldman Sachs and UBS are already adjusting their forecasts upwards, with targets of $3,000 to $3,080 per ounce by late 2025. These are still conservative estimates in light of what's happening behind the scenes. As Andy mentioned, this information isn't easy to find. It's buried in long reports, and the mainstream media isn't covering it because it doesn't fit the current narrative. Let's not forget silver in all of this. If gold is going to $3,000 or even $10,000, then silver is set to benefit in a major way. Historically, silver tends to follow gold, but with a much higher beta, meaning its price movements are more volatile and often more profitable. If gold reaches $3,000, we could easily see silver shooting past its old highs of $50 per ounce and moving towards $100 or more. Silver also has a unique advantage over gold: its industrial demand. Silver is not just a monetary metal, it's also a critical component in many industrial applications, particularly in solar panels. As the world continues its shift towards renewable energy, the demand for silver is only going to increase. China, which produces the majority of the world's solar panels, has been aggressively buying up silver supplies from Latin America. They're even paying more for raw silver than what it costs in refined form because they see the strategic importance of securing this essential resource. This gives silver a dual tailwind. It benefits from monetary demand as a hedge against currency devaluation and inflation, and it also benefits from industrial demand, which is set to grow exponentially in the coming years. There's also an interesting discussion to be had about the suppression of gold prices. For years, major banks have been accused of manipulating the price of gold to keep it artificially low. This is done through massive short positions on both the London Bullion Market Association, LBMA, and the COMEX Futures Exchange. But as Andy pointed out, you can only manipulate a market in the direction it's already going. When central banks are voraciously buying gold, when the Fed is cutting rates, and when inflation is running high, it becomes increasingly difficult to keep gold prices suppressed. Eventually, the fundamentals win out and the price explodes. This is why we believe that gold is still undervalued, even at current levels. The true value of gold, if allowed to trade freely, could be significantly higher. Imagine a scenario where central banks continue buying gold, the Fed keeps cutting rates, and public sentiment shifts towards precious metals. In such a scenario, $10,000 gold doesn't sound so crazy anymore. It sounds inevitable. It's worth mentioning that when major institutions like Goldman Sachs and UBS start coming out with bullish forecasts, it's often a sign that they've already positioned themselves for the move. By the time the public hears about these targets, the big players have already bought in, and they're getting ready to profit from the price increase. Goldman Sachs has reported being inundated with requests for precious metals on their trading desks. This is a clear sign that the big money is starting to move, and it's a signal that individual investors should pay attention to. The key here is to be ahead of the crowd. Don't wait until gold is at $3,000 to start buying. By then, the easy gains will be gone. In conclusion, we are witnessing a major shift in the global financial landscape. Central banks are buying gold at an unprecedented rate, the public is starting to return via ETFs, and the Fed is cutting rates, all while inflation continues to rise. The BRICS nations are exploring a gold-backed settlement currency, and the US dollar's dominance is being challenged. All of these factors point to one thing: much higher prices for gold and silver. If you're watching this and thinking about whether or not to invest in precious metals, the time to act is now. Don't wait for the mainstream media to tell you it's a good idea. By then, it will be too late. Whether it's physical gold and silver, mining stocks, or ETFs, get positioned now before the real fireworks begin. As always, remember that gold and silver aren't just investments. They're insurance policies against the collapse of the financial system. And if history is any guide, The value of these assets will only increase as the world moves further into uncharted economic waters. Don't be the one left asking, "Why didn't I see this coming?" Get informed, get positioned, and be ready for what's ahead. Because this is the kind of moment that defines financial legacies.